this episode of Governance Dialogues, a program that I have the pleasure to host on a weekly basis. My name is Alissa, Kole, and I'm the Managing Director of Governance Center, a think tank and advisory firm that works with policy and corporate leaders in advancing various economic and governance priorities all over the world. And we've launched governance dialogues, in fact, during the Great Lockdown, with the idea to demystify and render more interesting and perhaps more accessible the world of economic and corporate governance in conversations with world's thought leaders, be they CEOs, chairmen, philosophers, and others that have interesting perspectives to share on the world of governance. And we believe that that world is actually more relevant than perhaps ever now, and that a lot of current policy and corporate debates can be better understood if gleaned through the perspective of governance. And in a way, we're doing so in intimate conversations with thought leaders in a way that cannot be perhaps gleaned from publicly available media, financial media sources. And let's face it, most debates that are ongoing in today's in the global economy can't necessarily be gleaned from public sources. So that's where governance dialogues in a way comes in and offers an interesting and perhaps hopefully unique perspective on current economic challenges. And in this program, we're looking at governance through a variety of ways, through the lens of governance of the IT, information technologies. We've looked at governance of international architecture. We looked at compliance challenges and various sectoral challenges. And today is actually the hour of the banking sector. And you might be asking yourselves why. And I think there are a number of important reasons for that. One of which, of course, is the fact that banks are currently disbursing enormous amounts of government support funding all over the world, destined to save enterprises, but also that they are renegotiating and addressing needs, borrowing needs of corporations worldwide. And indeed, we've already had the opportunity to look at the banking sector in conversation with Sunil Mehta, the chairman of Yes Bank, one of India's largest banks that is trespassing an enormous crisis. And today it gives me great pleasure to take perhaps a little bit of a longer view on the future prospects, the stability of the banking sector and its governance, in conversation with somebody that has actually had the opportunity to sit on both sides of the coin. That is to be the regulator and the regulatee. And I think that is a unique perspective that we're delighted to explore in a little bit further detail with you today in conversation with the CEO of Gulf International Bank, Abdulaziz Al Helassi, who's joining us. I'm not sure if from Riyadh or from Manama today. Abdulaziz, ahlan wa sahlan, welcome.
Hi, how are you? Nice to see you, and thank you very much for giving me this opportunity.
Thank you so much for joining us today on Governance Dialogues. It is a true pleasure to have you, and we've always had fascinating conversations. I think the last time we saw each other physically was in Riyadh at the Future of Investment Initiative, where we managed to find each other in an audience of about 6,000 people. And you've always had an interesting perspective in conversations in Saudi and beyond internationally on sharing your views on governance, on the banking sector. And it's a pleasure to have you back to this program today. So just for the purpose or for the benefit of our audience, you've had a number of hats, obviously now as the CEO and also on the board of Gulf International Bank. You've been in senior positions with a number of financial institutions, JP Morgan Chase, Standard Chartered, and of course, last but not least, as the deputy governor of SAMA, Saudi Arabian Monetary Authority, the country's central bank. And that's indeed where I think I first met you when a number of years ago. And so I would like to perhaps start our conversation by looking at immediate challenges and that banks worldwide are trespassing. And that is the sort of the transition to virtual. And of course, that transition is not unique to the banking sector, but is perhaps interesting to discuss in the context of banks. The transition to virtual AGMs, the transition to virtual board meetings, and how you are living that in a very practical way as a CEO and as a board member of the bank, and what challenges you might be seeing in that regard.
First of all, Alissa, merci beaucoup. Thank you very much for giving me this opportunity to speak today. Just one clarification, I was never with Standard Chartered Bank. I was with part of the HSBC group, which was Saudi British Bank, before I moved to JP Morgan, from JP Morgan into regulation, spent three and a half years there as a deputy governor. And then since 2016, I've been the group chief executive of Gulf International Bank. But let me begin by saying that one has to understand exactly the composition of the bank. I mean, the composition of the bank, first of all, it is owned by the Public Investment Fund, but it operates independently and commercially of the Public Investment Fund. Their influence is very limited. When we need their help and support, they will provide it. We have 2 board members representing the PIF on our board, which is a big difference to how the Public Investment Fund was operated previously. And the reality is their contribution is immense. They want to support the bank, and they obviously their intention is to ensure that we get the best return to the shareholders as we develop the financial services sector. To answer your question about the transition to virtual, first of all, I gave you a little bit of a background of the bank. The bank is 4 columns. It is GIB, the parent, which is in Bahrain. It is GIB, Saudi Arabia, which was established in April 2019. It is GIB Capital that runs the investment bank. So debt capital markets, equity capital markets, debt advisory and asset management. And then GIB UK, which is primarily treasury and trade and institutional asset management. Now, obviously, the biggest challenge is let's not work in silos. Let's bring that all together, and how can we leverage on each other to actually improve the way we do business within the group. But why I bring this up, I want to start off by saying that in April 2019, when we established the bank, we were asked by the group chairman to actually re-strategize. So what will be our strategy with the introduction of another bank, or when we converted from a branch to a full-scale joint stock company? We created this plan. It was a 5-year strategy we put together. It was a 5-year model, and we put some target metrics there. We know that Saudi Arabia is the biggest part of the GCC, so we had to focus on our customer acquisition, balance sheet growth, profitability levels, and how each part of that engine would be used to achieve it, within the wholesale bank, treasury, investment banking, and etc. And also within the support functions, what we needed to do to manage those costs, right, as we work within a much larger group within the 4 entities. So we put a detailed plan along with the costs, which I hope that we are beginning to achieve. However, the onset of COVID-19 comes in place. And so we have to start focusing on 3 things. So we had to deprioritize a lot of that plan because the playing field changed. So we focused on revenue generation and cost optimization, and I'll tell you why. I think the acceleration of our digitization approach, and obviously I'll talk a little bit about MEEM, which is our retail bank, our digital retail bank, Sharia compliant, and then the focus on market readiness to ensure how prepared we are as a bank to take advantage of the opportunities arising in the post-crisis era. But let's talk about realities. What has the impact of COVID-19 done to us? Number one, it has had an impact. All the banks have felt the pain. Revenues have fallen. There's less trade within the businesses coming towards Saudi Arabia, people who want to trade. We've had to put in, I think most banks have looked at higher provisions because of higher probability of default, expected credit losses, etc. Right? But the goal has always been to ensure that as market liquidity tightens, and I'll explain why we believe it will tighten, that we have a robust liquidity position to support our existing customers. And why do we think, please go ahead.
No, I just wanted to ask a question related to the challenges that you're facing. And indeed, I mean, the banks in the Middle East, if we will sort of backtrack a little bit to the last financial crisis, I've been part of, and you have also been part of many conversations within the industry bodies, the Union of Arab Banks, the national industry bodies. And at the time, there was a prevailing feeling that, this is a quote unquote Western crisis. It does not really impact us. And today, I wonder if you can say a few words about how the banks generally in the Middle East perceive this wave, and whether they see it as a risk to their stability, and whether even policymakers above are worried, because let's face it, banks in the region, they're about 40% of the largest listed companies in Saudi, and specifically all banks are listed. So there are even broader implications for the economy beyond liquidity, banking sector stability, and all of that. Would you like to say a few words around what your thoughts are on the region?
I will, and let me focus a little bit on Saudi Arabia. Saudi Arabia, if you look at SAMA, they have been a very tight regulator from 2008 during the advent of the first financial crisis on to today. They have always been hands-on. They have always ensured that the banking sector was well capitalized, number one, that all the ratios were met, that they would also ensure that the coverage in terms of provisions set aside to cover non-performing loans would be sufficient enough to weather a storm, whether it be a big loss for for a single entity. So they have been very hands-on. They have put, if you look at some of the stimulus packages they put in before, if I'm not mistaken, Saudi Arabia, as part of a G20 country, I think in terms of the stimulus package was probably the highest out of all G20 countries back in 2008 to support the banking sector. This one I think is slightly different. Their goal has been to obviously put enough stimulus there to support a lot of the initiatives that have been developed over the last few years. So let me give you an example. One thing they're very sensitive of today is about employment or unemployment. If you go to the bottom of the food chain, you got SMEs, small and medium-sized enterprises. The reality of those is that because they're on the bottom of the food chain, whether they are a subcontractor, a vendor, or a supplier for a bigger contractor, the money dries up as they go down. So what have they asked the banks to do? They basically pumped in about a month and a half ago, 50 billion Saudi riyals. They've given that to the banks, and they basically said, please allow your SMEs to defer any installments required for the next 6 months, and we'll go beyond. The second one they did was about a week and a half ago. They injected another 50 billion riyals to ensure that we support even the larger companies, because this has been a massive impact to a country which is a net importer, to a country which is very dependent on oil revenues. When oil revenues dry up, right, then the government will slow down, right? They will issue less projects, etc. And that will have an impact on the banking sector. But the one thing that they have always focused on, whether it was during the first financial crisis of 2008 to this one, and we don't know where this is going to go, let's be honest, Alissa, we still haven't seen the end of this. They are on top of the banks. They're speaking to the banks every day. The managing directors of all the banks have, every 2 weeks, they have meetings and they want some insights on what's going on in the market. I'll give you an example. If you look at the loan book today, we haven't seen defaults, but we have seen a lot of large companies and small companies requesting a deferment or an extension to their installments, which is quite normal. But the larger companies, they're also doing something slightly different as well. They are asking the banks to draw down on any committed facilities because they want to lock in something for the fear of tomorrow that facility is not going to be available. We have to also look at what the government is doing. Lower oil prices, the government is borrowing more money. I think across the GCC, the governments are issuing sukuks and they're issuing bonds. And what does that do? That takes liquidity out of the market. And where's that liquidity coming from? It's coming from institutional investors. It's also coming from the banks. So when you pull out some of that liquidity, the cost of funding may go up. Even in a very low interest rate environment, the cost of funding will go up for the banks. And sometimes they might not have funds available to support some of the larger customers. So any committed facility today, from a company perspective, they've pretty much gone and they say, listen, we need to draw down. Even if they put it on deposit, even if they don't have time to deploy it, they just keep it there for a rainy day in anticipation that, and I think it's a wise and pragmatic approach, but in anticipation that things might get more difficult going forward.
Actually, it's an interesting point that you're raising around distinctions between impact on SMEs and on the larger corporates. And indeed, in Saudi, there have been some challenges with a number of large corporates and concerns in the overall banking sector, what impact that might have, the going concern questions around large companies like Saudi Bin Laden Group and others, but also across the region. We've seen some cases where, such as NMC, that is currently a company, an Emirati company, healthcare company that is listed in London, that is currently basically unlisting as a result of an enormous governance scandals, on one in which we've been widely commenting in the financial press, which also highlights perhaps the role of the banks in terms of doing due diligence on their clients and kind of looking at their role in governance from a slightly different perspective. What is the role of banks in sort of looking at how well their clients are run from a governance perspective? But what could be the risks to their loan book as a result is something that was highlighted as a result of the NMC crisis. And I wonder if you'd like to say a few words around some of the lessons learned, some of the misgivings in some of these enormous cases, you know, Al-Husaybi and Saad, others in Saudi, in the Emirates, in the region more widely, and perhaps even globally, and the impact that might have on banking sector stability going forward.
You know, I can look at this from two angles. I can look at this from the regulatory angle, and I could also look at this from the banking angle.
Of course.
And I will say that first and foremost, the biggest pain that this region has seen was Al-Husaybi Ma'na Sana 10, 11, 12 years ago. Not only because the local banks were lending, but also the international banks were lending, because this was a rated company. The fact that it was rated by the different rating agencies, I think the banks fell short of doing proper due diligence. I spoke at this conference for the IIF during the G20 summit. And this particular seminar happened just after the NMC crisis. The NMC happened. And my view is that the banks have fallen short, quite frankly, in terms of doing proper due diligence on clients. Now, due diligence is not looking at their financials and looking at disclosures. The due diligence is more really asking the right questions to clients, meaning that who is your board? How many family members do you have on your board? How do you address that? What kind of independent board members do you have? How strong, how influential is the family business or how controlling is it? What kind of subcommittees do you have? How good are the independent committees of audit committee, for instance, or the executive committee? Are they going to speak up for the right reasons? One thing that I have seen both in Bahrain and Saudi Arabia, though, is that if you look at the regulators, they have been a lot more diligent in terms of proving who sits on the board of those banks, right? I remember a few years ago, one of the biggest banks in Saudi Arabia, we are required, I think most regulators are required to either interview potential board members or approve them based on their CVs or, you know, etc. And we had one bank that had, out of the 11 board members, they had 5 or 6 who were family members of that bank. And from a governance perspective, you know, it was very much skewed. And this is also a publicly traded company, right? It was very much skewed to how the family wanted to run their business. So what we proposed to that particular institution was 4 or 5 really first-class board members, some of whom had banking experience. And it was accepted by the chairman at that time. So we worked very closely to try and improve the governance of the bank. And today, the result of that, quite frankly, it is probably one of the best governed banks, not because of what we did, but because the regulator was very hands-on in ensuring that the evolution of that bank from a governance perspective was focused to improve, because they had a number of issues in terms of correspondent banking, et cetera, that needed to be resolved. So I think that we have a long way to go. I think that the relationship managers and the banks have a lot to do to try and improve it. I'll give you an example of what we do, what I institutionalized. When we onboard a client, whoever it may be, I send out individual emails to every board member of the bank. And some board members may not want, in a bigger group, they do not want to divulge information that could be quite sensitive because they may accept responsibility. But to get feedback from those board members before we onboard, maybe they, as a businessman, they would have had a bad experience with them, or they would have some type of experience, etc. So they come back. Generally, what we try and onboard is good, but if we do get something negative, we do more due diligence. Number 2, once we onboard the customer, so we call it name clearance, once we do the proposal, we spend a lot of time understanding how the board operates, how the different committees within that company operate. We do a lot of interviews with the clients, even though they're multi-banked, but we are not willing to go through the pain that many other banks have gone through when it comes to Abraj or NMC or Mu'ajil or Al-Husaybi. So I think the quality of the portfolio, the issue begins on the onboarding. It's when the onboarding starts. That's where you've really got to start working hard on ensuring your due diligence is right.
It's interesting. I mean, I think that the point you're trying to make, if I hear you correctly, is around the fact that you are not divulging your responsibilities and you're basically doing your own homework, regardless of whether the client is rated or banked with other reputable institutions. And it's actually the point we've been discussing in previous dialogues. I mean, for example, I had the pleasure to host Michal Kanu, the chairman of Kanu Group, several weeks ago on the ongoing governance crisis in the region. And there are various points of view on this. For example, his point of view was that many of these companies were actually listed abroad. And so the responsibility, in fact, lied with the regulators abroad. So this is perhaps an interesting angle and conversation to pursue as we move forward with the governance dialogues. But I would like to, for the benefit of our remaining conversation and our remaining time, to perhaps ask a few questions around your thoughts on global banking sector stability, because that's obviously something that is unfolding and will be unfolding and being discussed in the financial press for weeks to come. And a number of prominent leaders, for example, Christine Lagarde, brushed off concerns around, for example, European banking sector stability recently. And I wonder what your thoughts are around the outlook for the banking sector more generally, and whether, for example, you see a risk, as we saw in the previous financial crisis, of governments becoming sort of unwilling shareholders of large financial institutions that they've had to rescue.
Yeah, I think it's always a good thing if you go back. I think that 2008 and the crisis there, I really believe that there were a lot of lessons learned, and we haven't gone a long period since then that people have forgotten some of the lessons learned. So if you go to a lot of the Basel regulations, if you look at what the regulators have actually done, they have actually tightened up the balance sheets of the banks. They've made them more robust. They have been much more hands-on. To me, though, the downside risk is today is impossible to predict. We don't know if this recovery that we're beginning to see, we're going to see a phase 2, and once again, there's going to be a downturn and there'll be a lockdown. But I actually think that banks, from at least what I say, banks are actually weathering the storm. But I still think it's early to judge, because I think there is a lag effect between the slowdown of the economy, right, and the ability for companies, right, who borrow money from banks to actually disclose their financials, whether they're public companies, whether they're private companies. But robust capital, not only from the banks, but also from the companies that borrow from the banks, I think is critical. But we are yet to see that impact, right? We talked about what large companies are doing right now to lock in funding. We've talked about SMEs and what they have done, or what the regulators have done to support them. And I think there is a bit of responsibility on the part of the governments to ensure that that they don't lose jobs, because when you lose jobs, it's going to have bigger implications. But I actually think they are better regulated today. They are more hands-on. I think they're better, I think, managed to weather the crisis. But it's not to say that some of the smaller banks won't fail. I have no doubt that maybe some of the smaller banks will consolidate. And the longer this crisis continues, the bigger impact it will have on the banking sector. But in summary, there's been a lot of lessons learned back in 2008 that are still applied today, and they haven't been diluted in what we've seen in terms of the economic growth over the past few years.
Okay, that's interesting. And sort of, I thought to perhaps end today's dialogue with a little bit of a forward-looking question on the future of the banking sector, and obviously in the region and beyond, the role of fintech as something that's been discussed over and over again, sometimes productively, others a little bit less so. And your bank has actually been, I think, at the forefront of these efforts in the region, in particular with the launch of MEEM, which is the region's first Sharia-compliant mobile digital banking app, which is kind of as far as I understood, meant to be kind of a one-stop shop for retail clients' banking needs. And I wonder if you could say a few words about that experience and what you think fintech will or stands to offer going forward to the banking sector, especially in light of this crisis. Is it, will the future of fin in the tech in the world of fin be different now that the landscape is also slightly different?
I think that's a very relevant question. And again, let me begin by saying that I think over the last 4 or 5 years, I think banks have realized that if they're going to survive, They need to be very digitally compliant. They need to improve their customer experience. They need to be applications. I mean, the newer generation, they do not want to go to branches anymore. They want to do everything. You know, I look at my kids. They are very, smartphone savvy. So for us, it was before my time. We decided to set up a digital bank where we have very light branches. We have no cashiers. We try and avoid paying, monetary, in terms of cash to clients if they want to withdraw cash, although we have corporate branches. I think the biggest challenge we had when we started this business off, and I think it still applies today in the Middle East, is getting the right people. Given it's a fairly new industry, very difficult to find people with experience. They can bring in traditional banking, but you've got to completely change the mindset if you want to succeed digitally. We've tried all sorts of I would say trial and error. How are we going to make this a successful bank? It's still a big challenge for us. But today, we have limited branches. As I said, we have no cashiers. We have been able to onboard clients without them visiting branches. We have been able to have them renew deposits, Islamic and conventional deposits, without having to go to branches. And now what we're working on right now is on the asset side, meaning that as long as the customer experience makes sense, how can we get clients to book loans and to take out mortgages without having to visit a branch? Obviously, we would have to work very closely with the regulator and the Ministry of Justice, who are trying to automate or digitize it with digitized order notes or promissory notes, digitized guarantees, digitized documents. Obviously, the asset side is a lot more sensitive when it comes to the regulators. But I think there is a joint effort between the regulators and the banks to make it happen. I think one thing I want to highlight, in the old days, when a regulator was asked to approve a new product or a service, they would try it and they would test it. They would try it, they would test it, and it would take time. Today, with this whole tsunami, this whole wave of the digitization of the banking services industry, they have changed their approach. They're basically saying, let's work with the financial institution. Let's put it in a sandbox. Let's give them a pilot. And let's say if we wanted to do it, let's do it with a limited amount of customers to limit the damage, if there is damage, and then grow. So their whole mindset has changed. And I think that everybody's racing, even in the region. The different regulators are racing in the region to be the fintech hub, to be the first country within the region to be fully digitized. And I think everybody's running with this race. But I think it's good for the industry. It's a good thing. And by the way, I don't think any other, I don't think traditional banks will survive, especially with the newer generation, if we continue the old system.
That is a big prediction. And I would like to perhaps, close with a little bit of a controversial question in 2 sentences, since we're talking about digitalization, and there's been a lot of conversations around contactless payments and perhaps, the going away of cash. We used to have this expression, cash is king. And I wonder if the new expression will be cash is dead. Do you have like in sort of one or 2 sentence kind of answer to whether to you cash is dead as a means of payment?
No, I think it's too premature to say that. And even globally, I mean, there are a lot of countries who are very predominantly working on cash. But if you look at some of the big countries, if you look at India, if you look at China, they are moving very, very quickly with the accessibility of smartphones. But there are countries that have populations that can't afford smartphones, so they would have to use cash as a means to interact. But the reality is, we are moving in that direction, and the regulators are very closely watching the different types of investments that the banks are making in terms of technology, in terms of processes of payments. I will say, I know this is more than 1 or 2 sentences, but I will say what is critically important for every bank is today they're making investments in applications and products and services, and these are big investments. And then the question is, how compliant or how good will they be in 2 or 3 years' time? So they have to choose what investment and what type of product they will be investing in today to be able to reap the benefits tomorrow. Otherwise, if they got into an investment and they've created a product and then all of a sudden that product becomes outdated because another new product has come out, then it's not money well spent. So I think that's one of the keys.
Thank you so much for that. So those last words of wisdom around the world of cash, because I think that's a relevant debate and one perhaps we'll be exploring in future episodes of governance dialogues. But for the purposes of today, thank you so much, Abdulaziz, for joining us and sharing your thoughts on the region and also on global developments in the banking sector.
Merci. Thank you very much, Alissa, and we'll see you soon. Thank you. Have a lovely day.
Thank you. And for those of you who are tuning in regularly to the episodes of Governance Dialogues, this episode will be available as well on the YouTube channel. And if you're interested to have a little bit further background on the world of governance and banking, you might wish to consult some of our reports. We produced, for example, a report on governance standards in comparison of governance in the Arab countries. So further resources are available, and we'll certainly be exploring the world of banking and governance in future episodes. But for today, thank you for tuning in, and thank you for joining us.